Have you ever wondered how exporters remain competitive in global markets despite customs duties and taxes? That's where export promotion schemes come into play. These schemes are designed to encourage exports by reducing or eliminating the tax burden on inputs used in export production. Broadly, they are divided into two categories: duty exemption schemes and duty remission schemes. In this video, we'll master two of the most important schemes for your CA final examination: Advance Authorization and Duty-Free Import Authorization, or DFIA. Along the way, we'll also focus on important exam metrics such as value addition requirements, timelines, exemptions, and frequently tested distinctions between the two schemes. Before diving into Advance Authorization and DFIA, let's understand the foundation. Duty exemption schemes allow an exporter to import inputs without paying duties upfront. In simple terms, the government waives the duty before production begins. The major schemes here are Advance Authorization and DFIA. On the other hand, duty remission schemes operate after exports take place. Here, duties paid earlier are refunded or remitted. Examples include duty drawback, RODTEP, and ROSCTL. An easy memory trick is, exemption means don't pay first, whereas remission means pay first and get it back later. This single distinction helps eliminate a lot of confusion in exams. Let's begin with the Advance Authorization Scheme, commonly called AAS. Under this scheme, three broad categories of items can be imported duty-free. First are inputs that are physically incorporated into the export product, allowing for normal wastage. Second are consumables such as fuel, oil, and catalysts that are used up during the manufacturing process. Third are mandatory spares that need to be supplied along with the export product. However, remember the important exam figure here. Mandatory spares can be imported duty-free only up to 10% of the CIF value of the authorization. Think of AAS as covering everything necessary to manufacture and deliver the final export product. Now let's see who can obtain an advance authorization. Generally, it can be issued either to a manufacturer exporter or to a merchant exporter supported by a manufacturer. However, there is one important exception. In the case of pharmaceutical products manufactured through a non-infringing process, the authorization is available only to a manufacturer exporter. The scheme also covers multiple categories of supply, including physical exports, exports to SEZs, intermediate supplies, deemed exports, and even stores supplied to foreign-going vessels or aircraft, provided a specific SION exists. Remember this point. AAS is not limited to traditional exports alone. Its coverage extends to several recognized export-linked supplies. A common exam question is, on what basis is an advance authorization issued? There are four possible routes. The first is Standard Input-Output Norms, or SION, which are predefined industry norms. The second is self-declaration, although certain specified products cannot use this route. The third is applicant-specific fixation of norms by the Norms Committee. Finally, there is the self-ratification scheme, which provides a faster mechanism for eligible exporters. Think of these four methods as a hierarchy of authorization routes, ranging from standard predefined norms to customized approvals. Understanding this framework is essential because many advanced provisions of AAS revolve around these issuance mechanisms. Imagine an exporter manufacturing a product for which no standard input-output norm exists. Normally, approval from the Norms Committee would be required, causing delays. To solve this problem, the self-ratification scheme was introduced. It can be used when no SION or valid ad hoc norm exists, or when the exporter wants to use a completely new additional input not covered under the notified norm. In such cases, the regional authority can issue the authorization directly without waiting for the Norms Committee. However, a chartered engineer certificate is mandatory. Think of self-ratification as a fast-track lane, but one available only to trusted and eligible exporters. One of the most important principles of advance authorization is the pre-import condition. The logic is simple. Duty-free inputs must actually be used in producing the export product. Therefore, imported inputs must be physically incorporated into the goods that are eventually exported. For local procurement, the same principle applies. Materials must be procured before manufacturing begins. Two important mechanisms operate here. An invalidation letter helps domestic suppliers obtain duty-free inputs, while an advance release order, or ARO, helps domestic suppliers claim benefits under deemed exports. In short, whether inputs are imported or procured locally, the government wants clear proof that they genuinely contribute to export production. Let's now discuss timelines, because timelines often become easy scoring questions in exams. In the normal course, an advance authorization remains valid for imports for 12 months from its date of issue. The good news is that it can be revalidated once for another 12 months through the online process. However, deemed exports follow a special rule. Here, validity continues either for the contracted duration of the project execution or for 12 months from the date of issue, whichever is later. A simple memory trick is normal AAS equals 12 plus 12, while deemed exports follow the project timeline if it extends beyond the standard period. Now comes a special version of advance authorization called Advance Authorization for Annual Requirement. This facility is meant for exporters with a proven track record. To qualify, the exporter must have export performance during at least the preceding 2 financial years. Another important restriction is that this scheme is available only for SION-notified items, and not for ad hoc norms or self-declared authorizations. The entitlement limit is highly important for exams. The CIF value of imports allowed can be up to 300% of the FOB or FOR value of exports in the preceding financial year, or 1 crore rupees, whichever is higher. Remember the magic numbers: 2 years, 300%, and 1 crore. Value addition is one of the most frequently tested concepts in export promotion schemes. The objective is to ensure that exports genuinely add economic value, rather than merely re-export imported goods. Under advance authorization, the standard minimum value addition requirement is 15%, although certain specified products may have a lower requirement. The formula is straightforward. Here, A represents the FOB value of exports realized or FOR value of supplies received, while B represents the CIF value of imported inputs, along with certain other eligible inputs. Think of value addition as the extra economic worth created in India before the product reaches international markets. One of the biggest advantages of the advance authorization scheme is the wide range of duty exemptions available. Imports under AAS are exempt from basic customs duty, additional customs duty, education cess, anti-dumping duty, countervailing duty, safeguard duty, transition product-specific safeguard duty, as well as IGST and compensation cess. In simple terms, AAS provides one of the most comprehensive duty exemption packages available under the foreign trade policy. However, there is an important exception. Certain specified deemed exports, such as supplies against EPCG authorization or supplies to the United Nations and international organizations, do not enjoy exemption from trade remedy duties like anti-dumping and safeguard duties. This exception is a favorite exam question. A crucial feature of advance authorization is the actual user condition. This means that both the authorization and the imported materials are strictly non-transferable. Even after the export obligation has been fulfilled, the imported inputs themselves cannot be sold or transferred. However, the finished goods manufactured using those inputs can be freely disposed of after completion of the export obligation. Another important point relates to ITC or CENVAT benefits. If such benefits have been claimed, the imported materials must be used only for manufacturing dutiable goods. As for waste and scrap generated during production, they may be disposed of even before export obligation completion, provided the applicable duty is paid. Sometimes a foreign buyer supplies certain raw materials free of cost to the exporter. Interestingly, advance authorization benefits are still available in such cases. However, while calculating value addition, the notional value of those free-of-cost inputs must be added to both the CIF value of imports and the FOB value of exports. Remember, this value is only for computation purposes. The actual export proceeds realized by the exporter will exclude this notional amount. The logic is simple. Even though no money was paid for those inputs, their economic value cannot be ignored while determining the true value added during the manufacturing process. For certain specified items, the law becomes extremely strict. The export obligation period is limited to just 90 days from the date of clearance of the import consignment. And here's the catch. Absolutely no extension is permitted. The imported material remains subject to the actual user condition throughout this period, and transfer of the raw material is prohibited for any purpose whatsoever, including job work. Think of this as a high-priority compliance category, where the government expects immediate utilization of duty-free imports and quick export performance. Whenever you see a question mentioning a 90-day export obligation period, immediately remember 3 words: no extension, actual user, no transfer. Now let's look at 2 important compliance provisions under advance authorization. First is duty drawback. It is available for duty-paid imported or indigenous inputs used in the export product, provided those inputs are not specified in the prescribed norms. However, the exporter must disclose details of such inputs in the original application itself. Second is the audit mechanism. The Norms Committee has the authority to conduct audits of manufacturers. In cases involving complexity, suspected incorrect norms, or possible excess benefits, a special audit may also be ordered. Importantly, such a special audit can be conducted even if the exporter has already undergone a regular audit earlier. Having understood advance authorization, let's move to its close relative, the Duty-Free Import Authorization Scheme, or DFIA. Although many provisions of advance authorization apply here as well, DFIA has several important distinctions. First, DFIA is available only for products covered by notified scions. Ad hoc norms are not permitted. Second, it allows duty-free import of inputs, oil, and catalysts used in the production process. Third, certain restrictions apply. Import of tires is completely prohibited under DFIA. Additionally, DFIA cannot be issued where a pre-import condition exists, or where the relevant scion prescribes an actual user condition. These differences form the foundation for most AAS versus DFIA comparison questions. One of the biggest distinctions between advance authorization and DFIA lies in the timing. Advance authorization generally works before exports, whereas DFIA operates on a post-export basis. However, the application must still be filed with the regional authority before exports begin. DFIA is available only for products covered under notified scions. In the case of merchant exporters, the name and address of the supporting manufacturer must be clearly mentioned on export documents, such as the shipping bill, bill of export, and GST tax invoice. Another important exam point is value addition. Under DFIA, the minimum value addition requirement is 20%, which is higher than the 15% requirement under advance authorization. Remember this difference. It is frequently tested. Now comes one of the most attractive features of DFIA: transferability. Unlike advance authorization, which remains subject to the actual user condition, DFIA issued by the regional authority is transferable. This means it can be sold or transferred, providing additional flexibility and market value to the holder. However, this benefit comes with strict timelines. Exports must be completed within 12 months from the date of online filing of the application and generation of the file number. The DFIA itself remains valid for 12 months from its date of issue. Most importantly, no revalidation is permitted. A separate DFIA is issued for each scion. So whenever you think of DFIA, remember 3 keywords: transferable, 12 months, no revalidation. Before we conclude, let's discuss an important rule common to both advance authorization and DFIA, the exact matching rule. If a scion permits generic or alternative inputs, the name and description of the input mentioned in the authorization must exactly match the description appearing in the shipping bill. During discharge of export obligation, the regional authority will recognize only those inputs specifically reflected in the shipping bill, along with the corresponding quantities. This rule also applies to supplies made to SEZs and deemed exports. For exam revision, remember 4 golden numbers: 15% value addition under AAS, 20% under DFIA, mandatory spares up to 10% of CIF value, and annual entitlement up to 300% of previous year exports or 1 crore rupees. Welcome to the CA Final IDT revision session on advance authorization, DFIA, RODTEP, and EPCG schemes. These topics are highly important from both conceptual and exam perspectives because they deal with export incentives, duty exemptions, and export obligations. In this session, we'll simplify the entire chapter into easy-to-remember concepts, understand the logic behind each scheme, and cover the most frequently tested exam points. By the end, you'll have a complete picture of import-export benefits, drawback mechanisms, RODTEP rebates, and EPCG obligations without getting lost in technical language. Before we dive into the details, let's look at the roadmap. We'll begin with import and export restrictions under advance authorization and DFIA. Then we'll understand domestic sourcing through EROS and invalidation letters. After that, we'll cover duty drawback, followed by the RODTEP scheme and its exclusions, which are a favorite area for exam questions. Finally, we'll discuss the EPCG scheme, including specific export obligation, average export obligation, and incentives available for early fulfillment. Think of this session as a complete revision capsule, covering all the major export promotion schemes in one flow. Let's start with restrictions under Advance Authorization and DFIA. As a general rule, prohibited items cannot be imported or exported under these schemes. However, there's an important exception. Under Advance Authorization, export of a prohibited item may still be allowed if it is specifically notified and subject to prescribed conditions. For state trading enterprise items, direct imports are not permitted under AA or DFIA, but domestic procurement from the saint is allowed. For exports of saint-reserved goods, a no-objection certificate from the concerned saint becomes mandatory. In case of restricted or SCOMET items, exports remain subject to the conditions mentioned in the relevant authorization or permission. Instead of importing inputs directly, holders of Advance Authorization or DFIA may choose domestic procurement. Inputs can be sourced from indigenous suppliers, state trading enterprises, EOUs, EHTPs, BTPs, or STPs. This procurement is facilitated through either an advance release order, commonly called an ARO, or an invalidation letter. One important point to remember is that the validity of these documents runs exactly parallel to the validity of the main authorization. Regarding export proceeds, realization must generally happen in freely convertible foreign currency, although realization in Indian rupees is also permitted where specifically allowed. Now let's move to duty drawback, which acts as a fallback export incentive. Suppose a supplier cannot avail schemes like Advance Authorization, DFIA, EOU, SEZ, or manufacture under bond. In such situations, duty drawback becomes available. The objective is simple: refund the customs duty paid on imported inputs used in exported goods. This ensures that taxes do not become part of export prices and Indian goods remain competitive globally. In other words, exporters should compete based on product quality and efficiency, not carry the burden of embedded customs duties. His slide contains one of the most important exam points. Duty drawback is strictly restricted to customs duty. There is absolutely no drawback available for GST. Students often confuse drawback with GST refunds, and examiners love testing this distinction. Drawback can arise in two situations. First, when imported materials are used in manufacturing goods that are subsequently exported. Second, when imported goods are re-exported in the same form, provided they are clearly identifiable. If you remember only one thing from this topic, remember this: drawback equals customs duty only, never GST. RODTEP stands for Remission of Duties and Taxes on Exported Products. It is based on a globally accepted principle that taxes should not be exported. The scheme refunds duties, taxes, and levies that remain unrefunded despite existing mechanisms. These may arise at central, state, or local levels and can include cumulative indirect taxes incurred during production and distribution. However, there is a crucial restriction. If the same taxes have already been exempted, remitted, or credited through another scheme, RODTEP benefits cannot be claimed again. In simple words, the law prevents double benefits or double dipping. Under RODTEP, benefits are granted in the form of transferable duty credit scrips known as e-scrips. These are maintained electronically by CBIC, making the process transparent and efficient. A key point to remember is that these credits can be used only for payment of basic customs duty on imported goods. Another attractive feature is transferability. Exporters who do not require the credits themselves can freely transfer them to other importers. This flexibility improves liquidity and makes the scheme commercially valuable for exporters. The RODTEP rebate is generally calculated as a notified percentage of the FOB value of exports, subject to prescribed caps wherever applicable. An interesting feature is that rebate issuance does not depend on immediate realization of export proceeds. The exporter can receive the benefit first. However, FEMA compliance remains critical. If export proceeds are not realized within the time limits prescribed under FEMA, the rebate is deemed never to have been allowed. In other words, the benefit can effectively be clawed back later. So while issuance is immediate, ultimate eligibility depends on FEMA-compliant realization. This is perhaps the most exam-oriented slide in the entire RODTEP chapter. Benefits are not available for exports of imported goods in the same form. Transshipment exports, products subject to export duty or minimum export price restrictions, prohibited or restricted exports, deemed exports, DTA supplies to CIS or FTWZ units, Section 65 warehouse products, exports under Notification 32 of 1997, exports through non-EDI ports and goods already put to use after manufacture. Whenever you see a practical question involving RODTEP, your first step should be checking whether the transaction falls into any of these exclusion categories. Let's quickly compare Advance Authorization and DFIA. The first difference is transferability. Advance Authorization is non-transferable, whereas DFIA becomes transferable after fulfillment of export obligation. The second difference is value addition. Advance Authorization requires a minimum value addition of 15%, while DFIA requires 20%. However, the method of calculating value addition remains the same in both schemes. A simple memory trick is 15 for AA and 20 for DFIA. This comparison is frequently tested through MCQs and short conceptual questions. Now we move to the Export Promotion Capital Goods Scheme, commonly known as EPCG. Its objective is to improve India's manufacturing competitiveness by allowing duty-free import of capital goods. These imports can be used for pre-production, production, and post-production activities. Capital goods imported for physical exports enjoy exemption from customs duties, including IGST and compensation cess, subject to conditions. The scheme is available to manufacturer exporters, merchant exporters linked with supporting manufacturers, and eligible service providers. In return for these benefits, the exporter undertakes a commitment to fulfill a prescribed export obligation. The heart of the EPCG scheme lies in understanding export obligations. Specific export obligation generally equals 6 times the duties, taxes, and cess saved on imported capital goods and must be fulfilled within 6 years. However, when capital goods are sourced domestically, the specific EO receives a 25% reduction and effectively becomes 4.5 times the notional duty saved. Alongside this, exporters must maintain the average export obligation, which is based on the average exports achieved during the preceding 3 licensing years. Remember, specific EO is always over and above average EO, not a substitute for it. The EPCG scheme rewards exporters who achieve their obligations ahead of schedule. Remaining specific export obligation may be condoned and the authorization redeemed if 3 conditions are satisfied. First, 100% of the average export obligation achieved up to that date must be fulfilled. Second, at least 75% of the specific export obligation must be completed. Third, this achievement must occur within half or less than half of the original obligation period, meaning within 3 years, out of the normal 6-year period. Faster performance, therefore, translates into significant compliance relief. Let's conclude with a quick revision. Under AUBL-A and DFIA, remember prohibited item restrictions, STE rules, and the value addition requirement of 15% versus 20%. For duty drawback, remember that only customs duty is refundable, never GST. Under RODTEP, focus heavily on exclusions and the FEMA-based clawback rule. Finally, in EPCG, clearly distinguish between specific export obligation and average export obligation, and remember the 25% reduction available for domestic sourcing. If these core concepts are clear, you'll be able to tackle both theory and practical questions with confidence in the exam. In this revision session, we'll master 2 highly important areas of CA Final IDT, EOU, EHTP, STP, BTP schemes, and the concept of deemed exports. While the first set of schemes focuses on boosting exports and foreign exchange earnings, deemed exports support domestic manufacturers under the Make in India initiative. We'll understand the objectives, benefits, conditions, compliance requirements, and exam-focused points in a logical and easy-to-remember manner. By the end of this session, you'll be able to tackle both conceptual and practical questions from these topics with confidence. Before understanding the rules, let's first understand why these schemes exist. The government created EOU, EHTP, STP, and BTP schemes to encourage exports, attract investments, and generate employment. The idea is simple: create a business environment where units focus primarily on serving international markets. As exports increase, foreign exchange earnings rise, strengthening the economy. At the same time, attractive incentives encourage both domestic and foreign investors to establish businesses in India. Ultimately, these investments create jobs across sectors, ranging from agriculture and biotechnology to software development and electronics manufacturing. The most fundamental condition of these schemes is export commitment. Every export-oriented unit, Electronics Hardware Technology Park, Software Technology Park, and Biotechnology Park unit is expected to export its entire production of goods and services. This is the core reason why these units receive various benefits and concessions. However, there is one important exception. The foreign trade policy permits certain domestic tariff area sales subject to prescribed conditions. Therefore, while the primary objective remains exports, limited domestic sales may still be allowed wherever the policy specifically permits them. These schemes are available to a wide range of productive activities. Manufacturing, repair, reconditioning, re-engineering, software development, and service activities are all eligible. Even sectors like agriculture, aquaculture, floriculture, animal husbandry, and biotechnology can establish such units. However, there is one strict prohibition that students must remember. Trading units are completely excluded from these schemes. The government wants these units to create value through production or services, rather than merely buying and selling goods. In exam questions, whenever you see a pure trading activity, it should immediately raise a red flag regarding eligibility. One of the biggest attractions of these schemes is duty-free procurement. Units can import goods required for their operations without paying basic customs duty, IGST, or compensation cess. Procurement can also be made from domestic tariff area units, bonded warehouses, and even international exhibitions held in India. However, all imported goods remain subject to the actual user condition. This means the imported goods must be used by the unit itself for approved export activities and cannot be freely diverted elsewhere. Also remember that purchases from the DTA attract applicable GST. These special units enjoy several financial and operational advantages. First, they are eligible for 100% foreign direct investment through the automatic route, making them attractive to global investors. Second, they can retain 100% of their export earnings in exchange earners' foreign currency accounts. Another important compliance requirement relates to export proceeds. Export earnings must generally be realized within 9 months. Additionally, these units enjoy exemptions from industrial licensing requirements for items that would otherwise fall under reserved sectors, thereby reducing regulatory hurdles and promoting ease of doing business. A key performance requirement for these units is maintaining positive net foreign exchange earnings, commonly known as NFE. The concept is straightforward. Foreign exchange earned through exports must exceed foreign exchange spent on imports and other outflows. In simple terms, earnings should be greater than outgo. This calculation is not done annually, but cumulatively over a block of 5 years, beginning from the commencement of production. Certain sectors may also be subject to higher value addition, or NFE requirements. For exams, remember the phrase positive NFE over a 5-year block. To establish an export-oriented unit, a minimum investment of 1 crore rupees in plant and machinery is generally required. However, there are important exceptions. This investment threshold does not apply to EHTP, STP, and BTP units. It is also relaxed for sectors such as handicrafts, agriculture, brass hardware, information technology, and services. Applications are considered by the Unit Approval Committee or, where applicable, the Board of Approval. Therefore, while 1 crore is the standard benchmark, students should always check whether the applicant falls within one of the specified exemption categories. Special units are not permanently locked into the scheme. Existing DTA units can convert into EOUs, and EHTP or STP units may also convert into EOUs where permitted. Similarly, a unit can choose to exit the scheme and return to normal DTA status. However, this requires approval from the competent authority and payment of all applicable duties, taxes, and cess on remaining goods. If the unit has failed to achieve its prescribed obligations, penalties may also become payable. Therefore, exiting the scheme is possible, but it comes with compliance and financial consequences. Now let's move to the concept of deemed exports. Unlike normal exports, the goods do not physically leave India. Yet the transaction is treated favorably under the foreign trade policy because it supports domestic manufacturing and saves foreign exchange. The objective is to provide a level playing field to Indian suppliers who compete against foreign suppliers enjoying duty benefits. This concept plays a major role in the government's Make in India initiative. Think of deemed exports as domestic supplies that deliver export-like economic benefits, even though the goods remain within India. The philosophy behind deemed exports is beautifully simple. Foreign exchange saved is considered equivalent to foreign exchange earned. For a transaction to qualify, the goods must be manufactured in India and should not leave the country. Payment may be received either in Indian rupees or in freely convertible foreign exchange. One very important exam point is that FTP deemed exports and GST deemed exports are completely different concepts. Whenever a question mentions deemed exports, always check whether it is referring to the Foreign Trade Policy or Section 147 of the CGST Act. Deemed export benefits are available for several specified supplies. These include supplies against advance authorization or DFIA, supplies to EOU, STP, EHTP, and BTP units, and supplies of capital goods under EPCG authorizations. Benefits also extend to certain project-related supplies, such as internationally competitively bid projects, zero-duty projects, mega power projects, nuclear projects, and projects funded by multilateral agencies or international organizations. The common theme is that these transactions either substitute imports or support nationally significant projects where the government wishes to promote domestic participation. Qualifying deemed exports enjoy multiple benefits designed to neutralize taxes and duties. Suppliers may obtain advance authorization or DFIA benefits for duty-free procurement of inputs. They may also claim deemed export drawback, which provides a refund of duties suffered on inputs used in manufacturing. Another benefit is refund of terminal excise duty in eligible situations where credit or rebate has not been availed. The overall objective is to ensure that domestic manufacturers remain competitive and are not placed at a disadvantage compared to suppliers benefiting from import concessions. While the benefits are attractive, the conditions are equally important. The first and most critical requirement is direct supply. Goods must be supplied directly to the designated project or eligible entity. Third-party supplies generally do not qualify. In cases involving subcontractors, payment must come from the main contractor rather than the project authority. Another important rule relates to site supplies. If an Indian subcontractor supplies domestically manufactured goods directly to the project site on behalf of the main contractor, the supply can still qualify for deemed export benefits, subject to prescribed conditions. Let's finish with a rapid-fire revision. For EOU type schemes, remember export entire production, no trading units, and positive net foreign exchange over a 5-year block. Keep the 1 crore investment requirement and its exceptions in mind. For deemed exports, remember the core philosophy: foreign exchange saved equals foreign exchange earned. Also remember that goods remain in India and must be manufactured in India. Finally, never forget the direct supply condition and the special subcontractor rules. These are the areas most frequently tested in both MCQs and descriptive questions, making them extremely important for examination success.